You're listening to CFRN, a community of believers who trade for a living. To learn more about who we are, what we do, and how we do it, call toll-free 1-866-928-3310, and we'll send you out a no-obligation information kit absolutely free. 866-928-3310. The CFRN Emini Futures Cast is now on Stitcher. Listen to us on your iPhone, Android phones, BlackBerry, and WebOS phones. Stitcher is smart radio for your phone. Find it in your app store or at Stitcher.com. Stitcher Smart Radio, the smarter way to listen to radio.
Are you ready, Steve? Andy? Yeah! Bert? Well, all right, fellas. Let's go!
You're listening to CFRN, the Christian Financial Radio Network.
Today's broadcast is brought to you by Audible. Get a free audiobook download at www.audibletrial.com/CFRN. Over 85,000 titles. Choose from mystery, romance, religion, science, technology, business, New York Times bestsellers, even children's books. You name it, Audible has it. With 85,000 titles to choose from, you're sure to find the perfect audiobook for yourself or to give as a gift, and it's absolutely free. Just point your browser to audibletrial.com/CFRN. That's audibletrial.com/CFRN. And become a part of the audiobook revolution by downloading your free audiobook today. audibletrial.com/CFRN.
Hey, trader, want to get rich quick? Well, good luck with that. If, on the other hand, you actually want to learn how to trade, the place to be is www.cfrn.net. Tune in Monday through Friday, 9 a.m. Eastern for our daily devotional, and then spend the next 3 hours learning how it's done from professional traders who actually trade for a living. That's www.cfrn.net. Every trading day from 9 a.m. to 1 p.m. Eastern. CFRN, a community of believers who trade for a living.
Good afternoon, trade. Founder in studio.
Hey, good afternoon. Welcome back. Today is Thursday, 11th day of July, 2019. Still experiencing audio difficulties here in Studio A. We've exorcised all the demons, the ghosts in the machines, replaced the modem, ran network sniffing tests, and goodness, kind of at a loss what to do next. Replacing the computer won't work because it's in the network. Maybe the node or the knock. All right. Welcome to the show. So glad you're here. Whoever you are, wherever you are, we're just glad you're right here, right now. I'll put a chart up of the S&P 500 Emini Futures as I do. Right. Here we go. There it is, S&P 500 Emini Futures. If you can't see the chart, go to our homepage at CFRN.net. On the right-hand side of the page, click the big microphone, follow the instructions. You'll be registered in about 30 seconds, and you'll have one-click access to the show each and every day. On the days you're out of the office, away from the desktop, and you still want to join the show, got you covered. Go to youtube.com/CFRN/live. There you will find live in real time a simulcast of this very show brought to you by the good folks at YouTube. Thanks, YouTube. Okay, S&P 500 Emini Futures. We've had a lot of sideways action going on after yesterday's big run-up. Okay, we had an S&P 500 Emini alert for all of our traders to consider being a long. 29.84 ran up 23 points. It's $1,150 per contract available. Of course, for those who earn the right to trade 10 contracts, well, the number's a little different. And you can certainly do the math. You probably don't need me to. Now, the cautionary tale is just because you have enough money to trade 10 contracts doesn't mean you should be trading 10 contracts. You should start in sim, whether you learn with us or anybody else. This is free information. Start in sim, become consistently profitable with that methodology, whatever it is, and then go live with one. Because trading something in sim and trading it live, it's two completely different worlds. Yes, the market's the same, the numbers are the same. What changes is you or me, our emotions, our mindset. We fall apart under pressure, and then we get it together. Most people who go live after being in sim and after achieving consistent profitability, they go live thinking that they'll never be in sim again because they've now crossed the blood-brain barrier, right? Well, maybe, maybe not. The purpose of the sim is not only for training in the beginning, but it's also for down the road when you hit a rough patch and all of a sudden everything was just flowing and flowing and flowing, and then what up? What happened? You can flounder around out there throwing money at the market, or you can make a smart business decision, step back into sim. We'll do a mentoring session. We'll figure out, we'll look at the charts, we'll look at the trade setups, we'll look at the market overall, we'll figure out why you hit a rough patch, what the rough patch was all about. Was it something you did, or was it something the market did? Maybe the market did something that you didn't understand, and therein lies the issue. Whatever the case, we'll sort it out, patch you up, get you back on the road. Now, when you step back into sim after being live, if you're at 2 contracts, 3 contracts, 5 contracts, 10, stepping back to sim to gather your wits and to stop the bleeding, it doesn't mean when you go live again, you got to start with 1 contract all over. No, you step back out right where you left off, but you step into the safety of sim for all the things I just said. Okay? It's a powerful tool. Use it. Don't ever feel embarrassed or ashamed because you had to go back to sim. It's a smart business decision. All right? Okay. We have another swing trade underway, and it's making folks a little bit nervous because we're pretty close to, well, we're not that close. We're relatively close. The stop's up at 3,010. Entry's down at 29.98 here. Well, I tell you about it when I can just show it to you. Hang tight. Swing, bada. All right, here we go. Consider short ESU 9, 29.98 to 29.92 to 29.78. The stop loss was published this morning when it triggered. And the reason that I do that, market structure changes, right? So I knew where I wanted my entry to be. I knew that last night. What I didn't know is what the market would look like when it actually triggered. So always think about that. If you get any kind of alerts or trade setups from anywhere, okay, look at the time it was issued and then look at the time it actually triggered. Because if more than a few minutes goes by, the structure of the market itself, price structure, let me show you what I mean. This, it changes, right? And hopefully you have some method for placing your stop. Hopefully you're not just using some random thing. Now, for training purposes, when you're learning how to trade, in our live training room, we do use a fixed stop loss, okay? But this is not rules-based trading. This is not mechanical trading. This is discretionary trading. As a discretionary trader, you got to let go of some of the things that are part of mechanical trading, and one is having a fixed number, okay? I will teach you, if you become a CFRN partner passport holder, I will teach you how to look at the market, how to evaluate the structure of a market, and how to know, without any shadow of a doubt, to the tick, where your stop loss needs to be. We believe in aggressive risk management, but we also want to maximize the opportunity of every opportunity that we have. All right? Okay. So I came back this morning, put the stop in, 29.98 to 29.78. So it's basically a 20-point trade. Stop loss 30.10. Okay, 3,010. And we're trading 3,003 right now. We're sitting in a weekly trading zone. Just to give you a quick peek. Yesterday's trades, we'll go over them in detail, but we got a couple thumbs up there, right? Yeah. Okay, so that's looking fine. I got just a little bit of news for you. I'm going to give it to you real quick. Well, I say I do. Do I really? Yeah, I do. Here it is. Dr. Tom today, Dr. Tom will be with us at the top of the hour. We'll talk to John before that. Gold, something we talk about quite a bit with Dr. Tom. In fact, if you've never been to CFRNgold.com, you should go there. It's one word, CFRNgold.com. Gold is a popular and secure investment that can be exchanged for cash and used for payment at any time. In the course of digitization, there is a new possibility if you decide to invest in gold and do not want to forego the advantages of cryptocurrency. We've heard a lot of talk about, is Bitcoin the new digital gold? Maybe it is, but I think it isn't. The Carat Gold coin, something I introduced you to yesterday, combines both components and is a blockchain-based cryptocurrency that follows the price of gold. Maybe you've been considering investing in classic gold because we talk about it so much, and you realize that every portfolio should have some exposure to precious metals. And you've seen Bitcoin make this incredible bull run of late, not to mention the one it had previously. And you're thinking, man, I probably need some exposure to this cryptocurrency. What if you could have two? I said two. Two investments in one. Well, it's possible. The Carat Gold coin presents itself as a hybrid between the two investment options and is your chance to make a safe, geopolitically, and economically independent investment that is always usable as a means of payment. The advantages are obvious. For physical gold, you will need a deposit box, a safety deposit box, a safe, something, while the Carat Gold coin is traded over a blockchain. You cannot make online payments with physical gold. A cryptocurrency is not based on a tangible asset, but the carat gold coin is. The carat gold coin will not become a pawn of speculators. You unite the advantages of a physical and virtual investment all in one. Instead of having to choose either or, you can rely on double benefits with this option. You choose an investment that is based on gold, but is not completely dependent on gold. Each carat gold coin is juxtaposed with a specific weight corresponding to the respective value of gold. You can exchange your investment at any time worldwide against physical gold, use it as a means of payment, or convert it into other cryptocurrencies. With carat gold coins, you keep investments flexible and seize an innovative option of modern markets to largely disassociate themselves from the state banking system and its difficulties. As has already been shown in the past, cryptocurrencies achieve high price increases and maximize their value significantly. Gold, on the other hand, is rather stable in value and thus a safe investment protected from inflation and loss of value. The combination of both options is therefore a decision that you make in the here and now with an eye to your future and financial security. You can purchase the carat gold coin at favorable conditions today during the introductory phase. You can exchange the coins for gold as well as for any central bank currency. And after the introductory phase, in which only direct purchase is possible, you'll be able to trade them on crypto exchanges and use them in payment transactions at over 500,000 locations. The carat gold coin is collateralizing 10,000 tokens with 0.1 gram in the ICO phase. I want you to study up on this opportunity. I want you to do your due diligence. I want you to kick them tires. And next week, we're going to have a guest or possibly two on the show. And they're going to be here just for you to answer any and all of your questions. Somebody put an X in the chat box for me, please, if you would be so kind. And I know you would be, because you're just good people. Here's my X. Okay. If you did not do this yesterday, you can do it right now. Okay. In the chat box, register as an affiliate. It is free, costs you nothing, no credit card required. And the reason it's important to do that is because I want you to be able to go into the back office and see all of the stuff that I was showing you yesterday. My exposure to this is brief. It's long enough that I've been able to just shake it loose and make sure there's no hoodlums or gangbangers hanging out in the hallway. And there isn't. This company is highly recommended by both Forbes magazine and Fortune magazine. I shared an article yesterday. Forbes has put it on their top 10 cryptos to watch in 2019. One last thing, then we're going to go to Michael for a recap. I began a channel, a humble channel, last night. And I gotta flesh it out. But right here, the channel is Carat Bars. Okay, and let me grab the link for you. Oh, that's right. It's very simple. Okay. I made this public, so if you just went to Telegram and searched Carat Bars, all one word, it would bring you right here. If you go to the Telegram channel, again, I just launched this last night. The link I just gave you in the chat box is the same as this link right here. Okay, it's a free account, won't cost you anything, but it's important that you register so that you can get into the back office and see all the stuff that's going on. All right, not just the pedestrian civilian version of the website, but the backside. And then watch this video. Got a lot more videos coming. The hidden secrets of money. This is pretty good. I got a lot of stuff. It's really good. I'm going to be sharing it with you in this channel over the next, till Jesus comes back, I guess. Now let me throw that in the chat box as well. That link I just, okay, it's t.me/. Okay. All right. Okay, so I put it in that one. I'll stick it in the other one too. That creates a hyperlink, it would seem. T.me/. That didn't come out as a hyperlink. Oh, I see one, I guess. Okay, there we go. All right, real quick, numbers from around the world on this Thursday. Starting here in the U.S. The Dow is currently up 196 points. Is that true? That is true. 197. NASDAQ is up 16. S&P 500 is up 7. The Russell 2000 is down 4. In the commodity basket, crude oil up 30 cents, trading 60.73 last. It's a gain of 0.5%. Gold up 70 cents, trading 14.1320 last. In the Asian markets, at the close, the Nikkei was up 110 points, 0.5%. Shanghai was up 2.5 points, and the Hang Seng added 227 points, almost 1%. In European markets, at the close, the FTSE was down 20 points, the DAX was down 41, and the CAC was down 15. That gives us a green day in Asia, a red day in the UK, and so far it is a mixed day here in the US of A, due only to the Russell, which is underwater. We have no movers or shakers in the indices here. Closest to that would be the Dow, which is up about 0.75%. With that, let's go to Michael, get a recap of everything that happened in the live training room today. After that, I'll be back. We'll talk about alerts from last night. We'll talk about anything you want to talk about. Talk about Concierge. We'll talk about logic. We'll chat with John. And then at the top of the hour, we'll talk to Dr. Tom. All that and answers to your questions when I return. Michael, it's all yours.
Excellent. Everybody should be looking at my desktop now and seeing our home page. Okay. If you have not taken a free trial with us and you want to take a free trial with us, go to the home page at CFRN.net. And right away here in the right-hand column, it says 5-day free trial, apply.cfrn.net. If you click on that, you will be brought to this page. And on this page, all we ask for is your name, your email, and your phone number. You can tell us your biggest trading challenge so we can try to tailor the training to you. That would be the one-on-one training. We'll try to tailor that to you. If it doesn't get covered in what I normally do, hit the send button, and then you'll be sent all the information that you need to get into the live training room. Okay? Okay. Oops. Hang on. I don't have my spreadsheet up. Microsoft was kind enough to reboot on me again. In the spreadsheet today, let's bring it all the way down to today. As I said, today is the 11th day of July. Today we made 6 ticks in crude, 2 ticks in gold, and 2 ticks on the ES. That put us at plus 105 on the morning session. Today it took 106 minutes and 7 trades to get to the goal for the day, and we took a total of 7 trades. That puts us on the month at $882 per contract. That's over 8 days, averaging $110 per day. On the year, we're now at $15,430. That's over 121 days, and we're averaging $127 per day. That's one contract, 2 hours per day. And I usually miss a bunch of trades. And I'm going to go over all those trades right now. Here we go. This was the gold. Okay, I'm just having like that FedEx truck get out of my neighborhood. This was the gold. We ended up the break even right there, a +2 there, another break even there, and yeah, and that was it. Let's see, during the break, we had to wait until we got an uptrend going. Then right here, this was toward the end of the session this morning. There was a long opportunity right there that I missed. It put in a higher swing, but then it changed directions on us. And it gave a shorting opportunity right here for that leg down. Okay, now the shorting opportunity would have been a close below that trend line right there. Okay, now on the euro, yeah, well, you can see what the euro did today. We didn't do anything with the euro. It just didn't trend. And even during the break, I think this was the low of the day, so we wouldn't have had a trade set up right here either. Okay, so there was just absolutely nothing on the euro today. And I'm really thinking of replacing that with something else. Okay, crude, again, my favorite market. We started out really choppy. Okay, right in here. We started out really choppy. And it made a leg up, but then it got choppy again. And then it made a leg down and didn't give us a trade set up. And then finally it started giving us some opportunity. On the first one right here, we picked up 1 tick. Then we had a break even. Then we picked up 5 ticks to put us at +6. This is where we got our goal for the day. It was at 11:15. Since then, on this one right here, and then it went up into this zone that's right here. Now let me see if I can figure out what's going on with that zone. Go to view, all active indicators, weekly trading zone. The count is set properly. The zone is set properly. Yeah, all the colors are set properly. See, it's not even showing up on a 5-minute. Usually that will do the trick. There's one way down there, and it's showing one up here, but it's not showing one right here, and I think we have one right here. Anyway, regardless. I'll figure that out later. Okay, so back to the spreadsheet. Okay, if you're going to read the spreadsheet, you can read all the CFTC risk disclosures down at the bottom. Today is the 11th day of July, 2019. Today we made 6 ticks on crude, 2 ticks on gold, and 2 ticks on the ES. That got us to plus 105. We took a total of 7 trades today. It took 106 minutes to get to the goal for the day. And on the month, we're at 882.5. That's over 8 days, averaging 110 per day. On the year, we're at 15,430. That's over 121 days, averaging 127 per day. 127 per day. Okay, now if you have not taken a free trial with us, go to the homepage at CFRN.net. And in the right-hand column, it says 5-day free trial, apply.cfrn.net. Just simply click on that, and you'll be brought to this page right here, okay, where all we ask for is your name, your email, and your phone number. You can tell us your biggest trading challenge, so we can try to tailor training to you specifically. Hit the send button, and then you'll be sent all the information that you need to get into the live training room, okay? All right, and with that, we can pass it back out to fabulous Phoenix, Arizona, overlooking South Mountain, Studio A, America's largest city park. It is big. It is big.
And there was a lovely, lovely moon over South Mountain last evening.
Was that last evening? I saw you posted a picture.
Yeah.
I thought it was at some point last week you posted a picture.
In fact, we have, by the way, good folk, we have a channel now just for shooting the breeze. Sometimes we have the alert channel. That's a one-way street. I'm the only one who posts there. That's where I push the alerts out to you live in real time as opportunity develops. Then we have the discussion group where any comments I have about a particular alert or questions that people have about trading, about the alerts, about our methodology, about our indicators, anything at all. You can ask questions in the discussion group and you'll get an answer. If I'm not around, Valerie's around or Michael's around, and you know what? I got a whole lot of traders in that discussion group that I trust implicitly. And most of the time, they can probably answer your question because they had a teacher, they've learned, and now they know the answer, okay? But sometimes we can get off into conversations that detract from the mission at hand, which is trading. So we created CFRN Breeze, a place that you can go to and just shoot the breeze. And you can post cute things like this. My wife asked me why I spoke so softly in the house. I said I was afraid that Mark Zuckerberg was listening. She laughed. I laughed. Alexa laughed. And Siri laughed. Hey, Alexa, laugh. Oh, somebody turn my volume down. I wouldn't do that to you. Alexa, laugh. Wow. Somebody messed up my Alexa. Alexa, are you there?
Yes, I'm here. I listen once I hear the wake word.
Alexa, can you laugh?
Sure, I can laugh. Tee-hee.
Okay, she's not much of a laugher, but yeah, you get the idea. All right.
It's not much.
Yeah.
I wonder if
Here's that
Siri's in your
beautiful moonshot over South Mountain. And it just looked kind of like that's the beautiful thing about an iPhone. It's kind of like the lottery when you take pictures. Sometimes they look good, sometimes they don't, but the film's free. So when I snapped it, I actually couldn't see this swirl of clouds around it, but you can, and that's magic. All right, it's the only kind of magic we have. We don't have any trading magic. All right, moon over South Mountain. What else of note might have wound its way? Just chit chat. anybody can participate in CFRN Breeze, even if you're not a passport holder yet. Turns out this little guy here was not guilty of my audio difficulties. Yeah. Oh, there's some good stuff here about the orphanage. We work with a group out of Germany called Teravitas, is how you pronounce it. Oh, that was Sunday morning off the front porch of church. New dawn, new day. That's our preacher there, Pastor Lori. So anyway, you get the idea. It's a breeze. Recap of the recap, sir.
Today it's 106 minutes, 7 trades to get to $105 per contract.
And that's a good bingo. I was in a mentoring session yesterday with a great gentleman. I look forward to him being a part of the CFRN family. He uses Ninja Trader. We were talking about the weekly trading zones. He had a question that I wasn't able to answer. Did you ever create a WTZ app for putting the zones on a Ninja Trader chart?
There's a couple different ways you can do it. There is a WTZ. Let me just go look, and I can tell you specifically.
If you need to take the charts back or something, you can.
Yeah. Why don't I do that for just a minute, because I got that other meeting coming up here soon. But I'll do that for right now and show you. Now, in NinjaTrader 7, there's a CFRN WTZ. That's for NinjaTrader 7. Okay. There is also, in the CFRN indicator set, there's a WTZ in here, but I have it set to false.
Okay.
Because it didn't work properly all the time.
Mm-hmm.
So I created this one. Well, I didn't actually create it. One of our partners created it.
Okay.
And I put it in NinjaTrader 7, but NinjaTrader 8 is different. Okay. Let me show you.
Ninja Trader 8 is just different, period, right? I mean, it's like a whole...
It is. Yeah. It's a whole totally different process. Everything is different. And, they totally changed it, and they didn't make it backward compatible.
Yeah, that just doesn't... That's
so
shades of Squarespace not making things... anyway, go ahead. That's my own pet peeve.
In here, I didn't create the CFRN WTZ for NinjaTrader 8, but I put inside the CFRN.
Mm-hmm.
Right here it says enable CFWTZ.
Okay.
And if you check that box, it's checked automatically by default. And I just have 2 numbers in here, so it's well, hang on. Let me do add. Okay. Now I can see.
Okay. Apply. Oh, I lost your audio. You're probably talking and I can't hear you.
I can pass the charts back over to you.
Okay, I just got your audio back. Yeah, that is so... I mean, we definitely know it's not the computers. Now we know it's definitely not the modem because we got a brand new factory sealed modem. So it is in the network, it's in the node, it's in the pipe, it's somewhere.
Because we can hear you the whole time.
Yeah, I hadn't. One thing I hadn't thought about, and I'm surprised the Cox guy didn't bring it up. My router, which is relatively new, but both machines connect to the same router, and I'm having the issue. I drop audio on both computers. So,
That's one common point.
Yeah, I guess what I'll do is I'll go to Walmart and get a router, keep my receipt, so that if that's not the problem. It's been about 3 years since I bought a router, so I'm surprised I didn't think of that sooner. Okay. All right. Well, I'll worry about that.
Well, you can take
later.
charts back.
Okay, I got it.
I'm going to start up the next meeting.
Okie doke. All right.
Okay.
Thanks very much. Any sign of John yet?
Hang on. Attendees. No.
All right.
No John's in the
Let
house
me
right now.
remind him that today is Dr. Tom Day, so he can jump in here and do what he wants to do and talk about what he wants to talk about.
Hello.
Hey, John, just a reminder, today is Dr. Tom Day. So if you want to pop in real quick.
Okay, you got it.
All right. Okay. He be popping. John be popping.
Okay.
All right. Last night, we ran into this weekly trading zone overhead. These are this week's weekly trading zones. 3003 to 3004. Now, we still have 2 zones above that. The next one overhead's up at 3020/3021. We've got this one here at 89/90, and then the one below at 76.77. Now, if we back up all the way to the 7th, which was Sunday night Globex Open, where we got it right there. That candle right there represents the Sunday night Globex Open. So we opened just above a zone. We came through it. We consolidated, a wee bit. Put in a leg, did a retracement, pulled right back up to that zone, confirmed that it would in fact be good resistance, and then it took us down to the zone below at 76.79. That journey from 89 to 77, that would be about a 12-point journey. So on the way down, we came very close to the zone. The swing low right here was 78.75. So we were 1 3/4 points off the zone. Back to the zone, back down the full 12-point move, and then some wide-ranging consolidation, which then took us down to this swing low at 65. And the correct zone below us is 59/60. Okay, what you see right here, this is unusual. Okay, at best it's unusual. When price departs a zone, headed for a zone, whether it's higher or lower, once we get this far in the journey, now this right here, this pullback, not unusual at all. Leg, retrace, leg, retrace, leg. Right here is where it got unusual, in that we did not continue down. The swing low here was 63.5, and we were looking for 60, so we were still 3.5 points off the zone. To see it turn and just run in the other direction, a little bit unusual. Okay. Now, if we take a look at that, we got lower into that price, looks like 2 weeks ago. Oh, there's John. Let me open up your mic, John. Hang on. Sorry, I was watching for you and forgot to watch for
That's
you.
okay. That's okay.
Oh, there you are. Welcome to the show.
Yeah, thank you. Thanks a lot. Thanks for the invite. I just wanted to say that you might not have mentioned it, that beautiful head and shoulders bottom there. That was quite a big deal because...
Which one, John?
Just squeeze it up again, like the way you had it.
Okay.
You can see it there, where the yellow arrow is, the kind of a head and shoulders. And that was quite, look, it was a little bit of a tricky bottom to pick because it, first of all, happened in the middle, I think it happened in the middle of the night, basically, and the early morning. And and then it took off on that publishing of the letter right before the
Okay, yeah, this is, okay, so this is when that 8:30
Yeah,
There's
and I
power
remember,
release that
look,
thing.
the night before, Morgan Stanley downgraded the market, and so it was you never know when a big firm downgrades, it certainly it accentuated that final decline into that bottom. But I was quite intrigued with that Head and Shoulders bottom, because that when you sort of see something like that pop up in a bull market, or like we've seen in the gold, we've seen double. You see, I mean, when you look at the gold market, you have to kind of be long-term thinking, and you have to, at least my personal feeling is that we are in a mega bull market. We're in like a 25-year bull market, 24-year bull market, something like that. And we're in the later stages of it, but we ran up to 1900, sorry, in 2011,
Right.
and we've had this correction, and we had this initial rally off the 2016 bottom, massive, biggest move up in gold stocks in 30 years. That doesn't happen by accident. That's a very bullish development. And then, we kind of got ahead of ourselves, and because of Trump and the dollar strength, we pulled back. But interestingly enough, there was a sort of a double bottom in gold at the last bottom, effectively. And that was very significant, because a double bottom in a bull market is just incredibly bullish. You got to bet on a double bottom anytime you see them in an ongoing bull market. And look at how rapidly we've gone up in gold since that double bottom. And we've basically gone up a couple of $100 that very few people saw coming. And so when you see a Head and Shoulders bottom or a double bottom in the stock market, you got to bet on it, because the odds are pretty high that's going to hold. And it's not just going to hold; it's what I call a quality bottom.
Get on the radio.
And a quality bottom is going to push prices much higher than you think. And I mean, look, we've hit one objective this morning. We've hit two objectives. We hit 27,000, and we've hit 3,000 on the S&P. Right. And as you know, I'm looking for about 3,300, at least 3,300 now, and 30,000 on the Dow. So it's more than likely going to happen in the next few months. This rate cut is pretty much baked in the cake after
He
what
certainly
Powell
makes
has
it
said.
sound that way, doesn't he?
Yeah, I mean, listen, he's virtually said it's on, and he, only a real shocker would stop it from happening now. So it's not only baked in the cake. There's probably several rate cuts coming. The guy, he's not stupid, doesn't want to lose his job. I mean, it's a little bit like this British ambassador. If you sort of step out of line, you're going to lose your job, or something bad is going to happen to you.
Right.
So especially with Trump, who doesn't pull any punches. So I think, as subtly as he possibly can, he's kind of yielding to the because of the rate cut, right?
Right.
So, and it's kind of like what we were looking at yesterday with Herbalife. As long as
Ackman.
what's his name was short.
Yeah, Bill
Yeah,
Ackman.
as long as he was short, the market was going to go higher, because it's a short squeeze against this guy. But as soon as he throws in the towel, the market goes the other way. That's what happened in 2000, when all these 6 mega bears, perma bears, if you like, who'd been short for the whole of the 90s, finally threw in the towel, at 2000, in the year 2000, right at the top of the market.
That article, John, yesterday referenced the 5 years that he had been, like a mad dog trying to take this company down. And it never came to light. It was never made public, at least not that I read, why he had such a personal vendetta against this company. I mean, there was something beyond, that was beyond, stocks and bonds and all that stuff. There was something personal. I just
Yeah.
so if we
Yeah.
back up 5 years,
Well-
what does that put us at? 2014, and it looks like all he really did was just send this thing higher.
Well, he made a huge mistake. The first time, there's a golden rule in this game, and I think you probably use it as much as anybody, which is always take windfall profits, And when he first shorted it
Yes,
back then, and
right.
it went
Look
down,
right here. Mm-hmm.
right, he didn't cover, and he was looking for too much blood and didn't get it, and then it sort of started going back up again. And actually, it wasn't just this that's happened previously. If you go back even further, you'll see that there was a big rally, and then there was a big sell-off, and he didn't cover when it went down the first time. See that?
Yep.
So the Wall Street can be a very brutal place, when you're the target of a short squeeze, just like that, Overstock, they had the same issues to deal with, they were getting shorted by the pros and all that. So what's kind of interesting about, the bonds actually are going down a lot today. They've kind of reversed, and that fits with my, there is a kind of a risk. The one thing that could really backfire on the Fed this year, because this is a little bit the Energizer Bunny. It's the longest recovery in history now, and I was just looking at a remark that Powell made earlier on this morning when he said that the consumer was pretty solid, and it's remarkable how the consumer has maintained, this incredible buying, continuous, support all through this entire recovery. The consumer has been the driving force of this recovery in a lot of ways, and you wonder how long how much longer than that can go on for. But if the recovery gets a second wind here, and which it could, like the perfect thing for recovery would be a couple of rate cuts, 2 or 3 rate cuts,
Right.
take the pressure off, get things going again. All of a sudden, you could get that sort of inflationary boomlet that nobody sees coming right now, and the gold market could already be seeing some of it. So, and ultimately, if something happens later on this year, where we, because of some deal that gets done, like infrastructure or something like that, all of a sudden the growth does surge to 4, 5, 6% because of inflation kicking into the system. The Fed's probably going to have to yield and go the other way, and might even start raising rates again. And there's an outside chance it could be like 1979, where all of a sudden inflation comes out of nowhere and gets out of control. You're sort of disrupting these product cycles, in production cycles around the world, where different, there's a lot of changes going on because the supply chain is changing from China to more to the U.S. centric, and maybe Mexican centric, more NAFTA centric, if you like, which is actually happening because of the USMCA. So that's something that's probably only just kicking in, and the benefits of that may be underestimated. If it's going to add 0.5% growth or even 1% growth, that's a pretty big deal. So if we suddenly see a spurt to 4%, and you then factor in a couple of percent inflation, you could be looking at 6% growth, by the fourth quarter, and or sometime going into next year ahead of the election, which would be great for Trump. But it might cause the Fed to have to react the other way. The other thing is, as we get into the election year, it's less likely the Fed is going to do anything because of conflict of interest, etc.
Right.
And it's I was just thinking today, we've had a tremendous third year of the third year of each election cycle, and this is what deregulation.
Those bonds drop. What just happened?
Well, right, exactly. You see what I mean? So maybe something the Fed
Look at my chart. You see it right now falling?
Yeah, I do.
Look at that.
Yeah, put up the data. Can you make it a daily, John? See what it
I
looks
sure
like.
can.
Boy,
Hey, Dr. Tom.
how's it going?
Welcome to the show.
Thank you, sir.
Let's see. Do I have
So
any
that's
news
a
anywhere?
pretty significant. That's a the makings of a monthly reversal right there. Look at that. It's taken out all of June's gains.
Yeah. Still got this little swing low right here, but yeah, you're right. Almost all of it.
Make it a weekly and a weekly and a monthly. See what that looks like. It looks pretty dramatic. Yeah, it's a big weekly spike there. So that could blow. That could potentially disrupt or minimize the Fed's cuts, if you like. Maybe they'll do one or two.
Okay. Now this is a continuous chart, so we can see way back.
Remember, this is what happened in '87, by the way, too. The economy got real strong just about now. Just started. Remember we're running about a month behind. But
look at the support, John, down at 150.
Yeah.
The red horizontal line across there.
Yeah. But its inability to get above that previous spike there a year ago would actually be very bearish, because it could turn down.
Well, I mean, a drop from here to 150. I mean, that's a substantial piece of change. For those of you that aren't familiar with bonds, there's 32 ticks to a point. Each tick pays $31.25 per tick. So if you take 32 and you multiply that times 31.25, it's $1,000, $1,000 per contract. And my audio, I think, just dropped again. I don't hear John. Dr. Tom, are you there?
I am.
Well, welcome to the show. Glad to have you with us.
Oh, thank you. Glad to be here. I can hear you fine.
Oh,
yeah,
there's
John, I've got to pop out.
Okay, John. We'll still be here if you want to pop back in.
All right. Much obliged. All the best, Tom. Bye-bye.
You too.
Oh, Roy just commented there's a bond auction going on right now. That's why we saw it drop like we did live in real time.
Oh, I see.
Is that what you were trying to tell me there? Oh, and Bill said that too, Bill B. There was a bond auction at noon, but it's already 1 o'clock. Well, there you go. That's the deal. Now we know. So, Dr. Tom, how's your week so far?
Good. My birthday was 2 days ago, so.
Happy birthday to you. That's my Marilyn.
I was going to say you sound like Marilyn Monroe.
Yep. Mm-hmm.
When I came on, I heard John saying something about Trump being subtle. And I kind of laughed to myself. Those are not two words that I would think of.
Right. No, I agree. Now, Dr. Tom, you're probably talking right now, and you're wondering why I'm insisting on talking over you. This time, it's not really intentional. Here's the deal. I've been having audio problems all week. I've already had the cable company out. We've replaced the modem. We've done all kinds of things. And I still am dropping audio in GoToWebinar on 2 different computers. So, everybody can hear you, and everybody can hear me. But for 15 to 20 seconds, I can't hear you. So, but I do have a little... Yep, there you are. Now you just popped right back in. It comes and goes. Now, have you ever experienced any kind of a similar problem with GoToWebinar?
No, I haven't. And if you're having the same problem on 2 different computers, then it's got to have to do with your either your internet feed or your modem router.
Well,
one of the two.
The Cox guy came out and he replaced my modem the other day. It didn't even cross my mind that, well, you've got another piece in the puzzle there, and that's the router, like you just said. So
yeah,
I know it's not the computers. No, it's not the modem, because I got a brand new one. So I guess I'll replace the router today. And if that doesn't clear it up, then I'll have to have Cox back out again to launch an investigation, whatever that means.
You don't have a switch, do you?
A switch, no.
Okay, all right. Then probably router, and if it's not that, it could just be problems with their stability of their signal.
Well, what he did, the guy, he was a real nice guy that came out the other day. You know, sometimes you never know what you're going to get, but he was a real nice guy. And after he worked in my office, he said, I don't have any other appointments, so I'm going to go outside, and where it connects, he goes, I'm going to run tests there at the tap, I think they call it. He said, I'm going to go down the street to the node or the knock or whatever that is, and I'm going to run some tests there. And every test came back A-OK.
Okay, I think we diagnosed it then.
All right, buddy. You want me to send you the charts?
Yeah, please.
Okay.
By the way, can you look up real quick and see how much the U.S. stock market has gained in the last 15 months specifically?
Okay, U.S. stock market gain in the last 15 months. I got a lot of smart people in the audience. One of them might know the answer to that off the top of their head.
I just didn't have time to get a chart up and check it out. Because that'll become important in a couple minutes.
Yeah. You know, I don't bring anything back with specifically, let's see what the gains are for. Let's try stock market gains. Okay, I got by year. Okay. Let's see. Let's see if this. Okay, so from January, I think this is going to work. So from January of 2018,
right,
to this just does it. Shoot. Okay, the return last year. Okay, 2018. It says it showing a negative 4.42.
Yeah, that would make sense because the last quarter it really crashed. But overall,
we had the worst December since 1932.
And believe it or not, that ended up being the worst year since 2001, as far as mutual funds are concerned. So it was even worse than 2008, and 2008 was pretty awful.
Okay, the stock market gain for 29. So we got a negative 4 there. And let's see.
I think it's been going pretty good for the last 6 months or so. Like year to date.
Just trying to grab a year to date number. It says here, S&P 500 up 7.16% year to date. And I'm grabbing this off some random site, so I can't vouch for its validity. Does that sound right?
All right, that's close enough. Yes, sir.
Okay.
That would probably, yeah, but it'll kind of fit in a minute. We'll see. Well, let me just start off by saying that I doubt too many of your listeners are dumb enough to be in mutual funds. But please listen,
if
folks,
you are, he meant no harm.
Yeah, that was not meant to insult. But a lot of people in them don't realize how bad they are. But even if you're not, listen for the next hour or so, because I guarantee you, your father, your mother, your grandparents, your aunt, your uncle are in mutual funds, and they need to know how much danger they're in. Okay?
Danger, Will Robinson. Danger. Remember that?
Yes.
Lost in space.
I not only believe they're dangerous, but I think they're obsolete. There's no good reason for mutual funds to exist today, except for the laziness of financial so-called advisors. Because two things. It's a lot easier to pick a mutual fund than to pick stocks, right?
Yes.
And if you pick a couple of mutual funds for your client and then they end up being dogs, you can say, well, those sorry mutual fund managers, we're going to fire them.
Yeah, you got
and we're
somebody
going
to
to
actually blame it on.
We're
Right?
going to get some other ones, right? There's no blame to the broker, right?
Right.
So there's two good reasons why mutual funds are the vast majority of retirement accounts today. Well, they're not good reasons, but they're two obvious reasons, let's put it like that. Okay. Now, in case anybody can't stay to the whole thing, I'm going to summarize this whole PowerPoint here in about 3 minutes. You likely own mutual funds, even if you think you don't. I'll show you why. Mutual fund gains are often fake because they kill their losers. Okay.
That's so tricky right there. That's so tricky, and I know you'll explain it.
Yes. Mutual funds do worse in general than the market in general. Now, here's a kicker. In 2008, they lost 45 to 50%, but stocks were down 39%. Why is that? It doesn't seem to make sense.
Yeah, right.
So basically, it's because you can't protect yourself with mutual funds like you can with stocks. You can put stops on stocks. You can buy puts on stocks.
You can hedge.
You can short stocks. Yeah, there's numbers of ways that you can hedge. You can't do any of that with mutual funds. So that's why in a down market, mutual funds always lose more. They're more risky than stocks and most any other investment. And here's one that really always upsets me. Even when you lose money, you can end up paying taxes on gains that the mutual fund made. Okay, and you lost money. Their fees, I'll explain how that happens. But it doesn't happen often. But the fact that it can happen just really irritates me. Their fees, many of which are hidden, are a lot higher than what you paid to negotiate stocks. They are definitely not as diversified as they claim. That's their big claim to fame, that they're diversified. Profitable fund managers get huge salaries, which come out of your profits. Okay. The brokers that just negotiate your individual stock trades don't get anywhere, just a few percent of what these fund managers make, especially if you're trading online. The managers often, I'm being generous there, often don't have the investor's best interest at heart. I think most of the time they don't. They're more interested in their record, in their saleability, because they always want to move up to a bigger fund, and so on. So they'll do things like window dressing at the end of the year. That's not to anybody's benefit except the manager. Now, any mutual fund site you go to, you'll see a growth of $10,000 chart. Okay, so they show over different periods of time. The average mutual fund, as I said, greatly underperforms the stock market. Now, I'm older than probably most people on here, so I look at a bigger time horizon. I don't look at things for the last 10 years. I look at 20 and 30 years. Over the last 30 years, the average mutual fund investor saw a return of 3.66%. That's less than the average inflation rate. So if you were invested in mutual funds, you lost money in real terms, in purchasing power. Even the S&P 500, which has not been the greatest place to be for the last 30 years, made an average return of 6.73%. So mutual funds roughly half the return, but most important, you lost money. One more introductory slide. This is something I found just before we went online, so I was quickly making this slide. U.S. News and World Report headline: Retirement savers lost $2 trillion in the stock market. The stock market turmoil has wiped out roughly $2 trillion of America's retirement savings over the past 15 months, according to the Congressional Budget Office. So there were some huge increases. Of course, there were some drops. But overall, if someone had been trading stocks, you could have made a lot of money in the last 15 months. If you're trading options, you could have made a whole lot more. And if you're trading the E-minis, you could have made even more. But almost all the retirement money is in mutual funds. So elderly retirees lost $2 trillion in a period of time when you could have made a lot of money. That's a big knock on the mutual fund industry. Now, this may be boring, but it's very short. I'm a big history buff, so here's a brief history of mutual funds. In 1774, a Dutch merchant investment trust. I'm not even trying to pronounce it.
You got to say it.
Yeah. Okay. Inglacht Magd. How's that?
Good job.
Okay. I spent a little time in Holland. It translated as unity creates strength. And it was a sort of an early precursor. In 1822, King William I, also of Holland, which they call it Netherlands, we call it Holland, launched an investment company. So that's kind of interesting. It'd be like Trump starting up a mutual fund today.
Yeah, right.
But the first two attempts were both in Holland. In 1849, near mutual funds were started in Switzerland. They didn't have all the characteristics of mutual funds. And then in the 1880s, similar investment vehicles were started in Scotland. In the US, it took us to 1893 before the first mutual fund in the US was born. That was the Boston Personal Property Trust. In 1907, the Alexander Fund was started in Philadelphia, and it was an important step in the evolution toward the modern mutual fund. It had semi-annual issues and allowed investors to make withdrawals. Some of the earlier ones, you couldn't make withdrawals before a certain period of time. In modern times, 1924, the Massachusetts Investors Trust, that we now know as State Street Investors, was founded in Boston. In 1928, the first no-load fund was
for
launched.
State Street. My Michael,
He did?
CFRN. Yeah. Before
Cool.
you met me, yeah.
All right. In 1928, the first no-load fund, I should call it a so-called no-load fund, because there really isn't such thing as no load. I mean, who's going to work for no money, right?
Yeah, what a load that is, huh?
Yeah, that's a load of something. And also in 1928, the Wellington Fund became the first to include both stocks and bonds. Before that, they were all either equities or bonds. Okay. Now, brief history of government regulation. By 1929, of course, everybody remembers that was the year of the Great Financial Panic. There were 700 closed-end funds and 19 open-ended funds. With the 29 stock market crash, the dynamic began to change because the closed-end funds were highly leveraged. And you see why in a minute. So they were pretty much wiped out. And small open-ended funds managed to survive even in the crash. But as a result of 1929, in 1933, 1934, and 1940, there were three major Securities and Investment Acts passed, the second of which actually created the SEC. It put regulations on this fledgling industry. They also put regulations on stocks, but a lot of it had to do with mutual funds. Okay, at the beginning of the 1950s, there were only 100 open-end funds in the nation. In 1971, Wells Fargo established the first index fund. And in the 1980s and 1990s, the bull market mania saw crazy growth in mutual funds with thousands of new funds and fund families. Remember that phrase, fund families.
Okay.
Today, we're talking 70 years later, there are over 10,000 mutual funds in the United States. So that's huge growth. in an industry that is not very good. Okay, closed-end and open-ended funds. You heard me mention both. And rather than reading all this, I'll just explain briefly. A closed-end fund is basically a group of pooled assets that goes through an IPO, but it's an IPO that cannot have a secondary. In other words, once it's started, there's always the same number of shares. So this is why closed-end funds can often trade at a higher price than their net asset value because of supply and demand. There's a demand for the fund. Even though its actual value is X, they could charge 1.2X. An open-end fund is similar, but what they do is they can produce new shares and they can redeem shares. So they can kind of keep things on an even keel, and the shares are priced according to the true current net asset value. Most mutual funds, just remember this, are the open-end type. So here's stocks versus mutual funds. It doesn't look very dramatic unless you look at the numbers, okay? I mean, you can see obviously the S&P 500 is beating the snot out of the mutual funds, but it doesn't look like that much. But look at the end game. The S&P 500, this is late in 2015, mid 2015, is north of the 1250 mark there. And the active mutual funds are roughly at around 725. So that's a huge difference. And that's the S&P 500. The S&P 1500 is not as widely known, but of course is a much more broad-based index. And if you look at it versus the S&P 1500, 2018 was the fourth worst year for mutual fund stock measures since 2001. It was actually worse than 2008. You see here, 2018, 68.83% of mutual funds underperformed the S&P 500. But in 2008, it was 64.91. All right. So last year was the worst year since 2001, which is over here, 54.87. And even in 2014, look at that, almost 87% of mutual funds underperformed the S&P 500. It's a very rare year when a few mutual funds do better than the S&P 500, which begs the question, why buy mutual funds? Again, laziness. Okay, have you heard this lie? They advertise all the time on TV. They claim that investing with them is safer than investing in individual stocks. Have you heard that lie, Dwayne? That said, yeah, I own mutual funds. What they don't know is that they own them through their insurance policy, through their annuities, through their IRAs, their 401ks, their pension plans, and so on. But what's even more shocking is they invest 26% of all their financial assets in these risky funds. Now, that doesn't sound so shocking, 26%. Okay, it sounds kind of like you're diversified, right? No, this is not 26% of their investable assets. This is all of their financial assets, including their home, including their the value of their pension funds, their IRAs, all investments. So 26% is an awful lot to put into one financial asset, particularly one that is not that safe. Here's a verse from the Bible, Ecclesiastes 11:2. It says, invest in 7 ventures, yes, and 8, you do not know what disaster may come upon the land. So people that have the majority of their money, or even a large percentage of their money in the stock market, may be really shocked when the disaster comes upon the land. Now, I mentioned earlier in 2008, stocks dropped 39.2%, mutual funds lost 45 to 50%. And most IRAs, 401ks, and all the other 401s, and other retirement and pension plans lost the same. So basically, retirement plans lost it big time, a lot more than the stock market. So why? Why would you lose more? Because mutual funds are stocks, right? Well, there's a reason. They're inherently riskier. That means just by their nature, they're riskier. In a secular bear market, if you're in a mutual fund, you don't have a chance because most managers can't go to cash. Probably didn't know that, did you? But look at the prospectus if you own a mutual fund, and some of them are only allowed to go to no more than 10% cash. That's because the people that run the mutual funds want the money invested. They don't want you going to cash because then you can take the cash and go to some other fund that's doing better. So they have rules in their prospectus that limit the amount of cash. So when we went into the bear market, and it really started in 2007, but we think it was 2008. These funds that couldn't go to more than 10% cash, if they were fully invested, all they could do is get rid of 10% of their worst dogs. If they were already 10% in cash, they had any foresight, they couldn't sell any stocks, even the worst ones, because they couldn't be in more than 10% cash. Another big problem with mutual funds is the once-a-day pricing. When I was a stockbroker, people call me up and they say, well, I want to sell part of my mutual fund. And I'd say, well, tell me how many shares you want to sell or how many dollars you want to sell. Mm-hmm. And he said, well, what's the difference? I said, well, I don't know the price. All I know is last night's price, so I can give you an approximate. If you want to sell $20,000, I can tell you approximately how many shares you're going to buy or sell. But until it closes, and it used to be half an hour after the market closed, it's probably quicker now with the supercomputers. I don't know the price of the shares. So they either have to tell me how many shares they want to sell, and then we find out how much they paid for those shares or got for those shares, or they have to tell me the dollar amount. But here's the two worst things. You can't put a stop on a mutual fund.
Right.
That's one of the basic things in any investor's toolbox is a stop. And you can't put any kind of stop on a mutual fund, and you can't short mutual funds. So this is why they lost, instead of 39%, 45 to 50%.
There are ETFs specifically created for the purpose of shorting, but an ETF is not exactly a mutual fund, right?
Right. That's right. It's a type of mutual fund, but it's not like. But when we say mutual funds, we're thinking of these open-end funds that price their NAV once a day. Okay.
Gotcha.
So
now, is that once-a-day pricing? Is that still done today? Because I know back when you were a broker, they didn't have computers back then. So, but with, I'm just kidding. No. Do they still just price once a day? Because you would think people would want to be able to log in and get a real-time update, but maybe not. Maybe they still do the once a day.
They still do the once a day NAV. Okay. If people want real-time price, and they go to ETFs.
Gotcha.
And they should. Gotcha. ETFs are better. Well, in early 2018, the fund managers were licking their lips. This is going to be a great year. This is going to be a winner. They were betting on a rare moment, something that very seldom ever happens. The world's major economies were all expanding together at the same time. So they said, a hot shot, This is going to be a great, great year. Mm-hmm. And that created what some described as the best investing environment of their entire careers. I mean, some of the fund managers are saying this, oh man, this could be great. But
What
who has a
followed was
crystal ball,
what followed
right?
was a little bit of a different story.
Right. And, we think of 2018 as a bad year. It wasn't, for 8 months, it was a great year.
Yeah.
But same thing in 2008. Most of the drop in 2008 took place in the last 3 or 4 months.
Same thing as
So-
1932.
That's right. I hadn't thought about it, but that's also true,
Worst December since 1932.
Were you trading the markets at 32?
I was just getting started.
Okay, you're a youngster then. All right. Now, in September, of
clerking.
course,
I was running orders.
I see. In September, when the markets fell, it was a whole different thing. 2018 ended as the worst year for stocks in the decade that followed 2008. And actually, as I showed you on a previous chart, it's also the worst year for stocks, including 2008 and going all the way back to 2001. It was a dog. Now, here's a question for you. Well, actually, I didn't show you this one yet. Here's 2018. Did I show this chart already?
I didn't. I don't recall it. I stepped out for just a second, but I didn't see it.
All right. Well, anyway, here's the percentage of mutual funds that did worse than the market, almost 69%. In 2008, it was only 65%. So it was worse than 2008 as far as fund managers' performance.
Mm-hmm.
I think I may have put that slide in there twice.
Okay.
But here's a headline on an article, very good article, by the way, by Bob Pisani, who you see on.
He's a pretty level-headed guy.
Yeah, he's on a bad station, but I won't mention the name. Anyway, he had 3 key points here after 2018, I mean. Fund managers who claim that they do better during periods of heightened volatility are going to have to find another argument, okay, because that dog don't hunt. For the 9th consecutive year, the majority of large cap funds did worse than the S&P 500, 64.5% of them. But even worse, looking at 10 years, 85% of large cap funds underperformed the S&P 500.
Wow.
And if you look at 15 years, 92% trail the index. And as you saw earlier, you go out 30 years and they hardly even show up. Okay. So again, why would people buy mutual funds? But here's a bigger picture. If you're in the stock market at all, think about this. Was 2018 a preview, okay, of things to come? In 2018, in their advertising, mutual funds weren't competing on a basis. Yeah, I made more than anybody else. They said I lost the.
That's good.
That somehow managed to eke out a positive return in 2018. Only 7, that's 1/5 of 1%, managed to make 10% or more. Well, in my book, if you're not making 10% a year on your money with average inflation over the last several decades of 5%, you're sucking wind, okay? You've got to make 10%. And only 1/5 of 1% of the profitable ones, and it's probably like 1/50th of 1% of all the funds, because only a small handful made money. It's pretty bad. So it's probable that 2018 will be our last warning before the big one. It surprises me that people are short-sighted in the markets. As long as things are looking good, they're happy. So if things are not too bad, for instance, in the economy, not everybody you know is not unemployed, whatever. They'll just go ahead and float along. Well, it's the same thing with the market. We've been getting lots of warnings. Okay, I mean, just the fact that this is the longest continuous run like this, that's a warning in and of itself. This super high that it's hit, that's a warning. But 2018, a lot of bad things happened. And so remember Fred, whatever his name was, the junk guy, that comedy, he'd always be pretending to have a heart.
Yeah, Sanford.
Fred Sanford. Yeah. Oh, it's the big one, Ethel. It's the big one.
It's the big one. Yeah, that was a great show.
Yeah. Well, 2018 might have been our last warning of the big one. This year or next year, we're going to see not just a correction. I mean, we were way too far past that. If it had happened 5-6 years ago, we could have probably gotten by with a correction, but no, it's going to be a crash. So I mentioned my skepticism about no loads. Mm-hmm. No load is usually untrue. We've all heard people talk about no load mutual funds. A load is a commission, but for obvious reasons, they don't like to use that word. But how can you run a business without making money? You can't. So almost all funds are front load or back load. Now, there are a few funds that are true no load. They don't charge any commission, front, back, or middle, but they have so many fees and charges built into it. It's the same as if they were charging commissions. And those are only when you buy them directly from the fund. When you buy them from a broker, there's always a load on it. So if you're going to buy a mutual fund, stay away from the front load funds because they take the commission out of the money you pay them. So you got that much less money working to try and make you money. So it's better to do it as a backload. But in those cases, they up the commission because they want to get their money as soon as possible. Okay, so here's a question. Why do people trust mutual funds? I mean, with all that we've talked about it, anybody could do the research I did. I mean, I don't have any secret knowledge. Right. Why would people trust mutual funds? Well, number one, huge advertising budgets. If you hear this name over and over and over again, Vanguard, you start to think, well, Vanguard might be a great company or must be a great company. And it might be, or it could be a horrible company. Another reason we trust them is because they're in our retirement plans. When we get our statement, we see, Fidelity, Vanguard, State Street, whatever. And we say, well, the retirement plans, these guys are experts, so they must be good. But the main reason is if you sit down with a financial advisor who obviously makes commissions, makes their living by selling you mutual funds, then you're going to think mutual funds are good. But they're not to be trusted. I mean, you could do much better just buying individual stocks, getting some training, and trading your own money. The Economist, talking about mutual fund performance. Past performance cannot guarantee the future results. In fact, to put it in plainer language, past performance is nearly worthless as a predictor of future results. They put it plainly. Economist is a real good publication, by the way. Slate Magazine, Henry Blodgett had a piece on why you should not pick your mutual fund based on past performance. He's right. The top fund one year is almost never the best fund the next year. Look it up. Go look at mutual fund ratings and look at the top 10 funds for the last 5 years. You will hardly ever see any fund maintain its position from year to year, particularly the top one. Slate says there's little statistical evidence of fund managers outperforming the market over the long term. Well, that's an understatement, Slate. I mean, there's a lot of statistical evidence proving that they underperform the market. short-term and long-term. Occasionally, some mutual funds, short-term, will do better. And when that happens, that's when we see all these bullets of mutual fund ads on TV, because they can finally say, hey, we beat the market by this percentage. But over the long term, no way. 90 to 95% of mutual funds underperform the market in any given year. Of course, that's going to change, bull market year, bear market year. But that's a pretty accurate number there. But even if a manager does outperform, you're not out of the woods, because if the fund outperformed, it was because of what the manager did, right? So if he does too good a job, he could get recruited away by another fund. Or he may say, well, I did really good. He may get complacent, play golf a couple afternoons a week. But here's another danger, and you never hear people talk about this, but if he's really successful, he can attract too much capital. Everybody wants to be with the winner, right?
Yeah, right.
So let's look at $100 million.
When they publish those lists every year of the top fund managers, whoever's, number 1 through 5 this year, don't look for them to be on the list next year. It just doesn't happen.
That's absolutely the truth. So if you look at a small mutual fund, like $100 million versus a behemoth with $10 billion under management, the bad thing about having a lot of money under management is a manager with more money can invest in more companies, but he's going to have less time to analyze them. So are they going to be the best companies?
Yeah, I mean, it's more difficult to find a place to put 10 billion, than it is 10 million.
Right.
A lot more difficult, because you only want to put money to work where good opportunity exists, high probability opportunities. And you can't, let's say you find a company that you really like. There's certain rules about how much stock you can own and disclosures you got to make, but there's only going to be so much, stock available in any particular company. So you're limited. Even when you find good opportunities, it can't suck up $10 billion. Finding a place to put it to work where it's actually going to bring home a return, the more money you got, the bigger your problem. Yeah, that's true.
Because you're bidding against yourself. If you're trying to put a lot of money into a thinly traded stock, you're going to push the price up and cost yourself a whole lot more money. So as a result, they miss a lot of good opportunities, really good stocks. You look at certain funds, you say, why in the world is so-and-so not in there? Well, it's because that stock couldn't absorb that much money. So how big are mutual funds? Well, in 2017, listen, this is wild. There were 114,132 open-end mutual funds worldwide. It's closer to 130,000 if you count the closed-end funds. And half of those fund assets are concentrated right here in the U.S. That's a lot of money in mutual funds, friend.
Sure is.
Funds gone. I mentioned there are more mutual funds than there are listed stocks. Can be a shocker. There are also more dead mutual funds than there are listed stocks. Did you know that?
I did not. I did not know that.
That is wild. That is wild. Because those are not counted in the figures, right? So last year alone, more than 1,000 funds ceased to exist. So let me take a little side trip here for a second. I'm not sure if everybody's familiar with the concept of fund families. When we say Vanguard, we just think, oh, Vanguard.
Right. Or Fidelity or...
Yeah. So there's 10,000 active mutual funds in the U.S., but most of them are owned by one of only about 200 fund families. So that's an average of 50 funds per family. There are one-off mutual funds, a mom and pop fund that's not part of a family. There's some fund families that only have 5. There's some that have 200.
Yeah, right.
But let's say an average of 50. Okay. How did they get away with not reporting the results of their dead funds? It'd be like if I go through college and I have a 4.0 average, but I flunked some courses. How did that happen?
Well, it would be like me when I publish my weekly recap for the Logic 247 Emini Alert service. What if I just published the winning alerts, the profitable alerts? I hate that word winning. Profitable alerts. And the ones that got stopped out, we don't even count those. Oh, that got stopped out. It's dead. Oh, and I just dropped audio again, I guess. You still there?
No, I'm just listening to it. It's interesting. But yeah, that's true. You can't do it. It's not ethical.
It's not.
But that's what they do. So I made this little chart, and I didn't
People
use
would be
the
chasing me
actual.
with a stick if I tried to do something like that. I mean, that's bad business. Shameful. Go ahead.
So this is just a random 13 stocks, and because I don't want to get sued, I'm not listing the names of the mutual fund companies. So I just used Marine Corps terms: Alpha, Bravo, Charlie, Delta, and so on.
Gotcha.
Okay. Now look at this column. Here's the advertised return: 5.3, 3.1. Not bad. 3.3. It's less than inflation, but there's one was 10%, 11%.
Right.
Average 6.29%.
No movers or
That's what
shakers
they-
in that list.
Right. Now, look at this list. These are the active funds, okay, that they haven't killed off yet. Oh, look. Exactly same returns. Why? Because the dead funds in this column are not included. It'd be like me, all the classes that I flunked or that I only made a C in, I just pay the registrar off to take them off my record. So I got a 4.0 average. They only count my A's, right?
Mm-hmm.
So here's the same fund, the Alpha Fund, not the same fund, I'm sorry, but the same companies, okay?
Right.
A loss of 20.6%. You know they killed that one. A slight gain of 1.1%. It's dead, it's gone. 15%, 32.6%. So the average, 7.68%. So if you average together the active funds and the dead funds, the real returns are a negative 0.7%.
For the fund family.
So, yes.
Right. Okay. Gotcha.
So that's why the concept of that fund family is so important. They only advertise and brag about the ones that they kept. Now, it's not just mom and pop shops. According to Money Magazine, major players like Prudential, Merrill Lynch, and Smith Barney have all eliminated at least 40 of their mutual funds. I mean, these are supposed to be the people that we trust, but they just eliminate them. It's okay if they eliminate them if they include the figures in the track record. It's not okay when they hide the truth. Now, there's something called survivor bias. This can lead analysts and people like us, individual investors, to misinterpret the relative strength of different sectors or of fund families because we only see the survivors.
Right. Right.
There was a 15-year study done.
That's like when you look at stochastics on a chart. You know, after the fact, it looks like a magic wand. I mean, it's mystical. In real time, it's a completely different story. And you only see when you look at a chart. You look at, and I don't. It's not an indicator I use, and I'm not picking on it because I understand it does what it was created to do perfectly well. So I'm just making a point. Is the trades that failed, you don't see a signal. The trades that work out, you do see the signal after the fact, not when it's happening. When it's happening, you don't know if it's going to be one of those that works or doesn't work. If it doesn't work, it's not going to show up as a valid signal. Anyway, I don't want to get too technical here. Go ahead.
So who needs a lagging indicator, right?
Yeah, right.
So they did a 15-year study
have an oracle of light
of survivor bias. Many funds were liquidated because of poor performance. So the survivors give the appearance that the group is doing better than it really did. The report says the disappearance of the funds is meaningful. Now look at this. In the last 15 years, 57% domestic equity funds, and 52% of all fixed income funds, bond funds, were merged or liquidated. So that means on average, 50% of all mutual funds just disappeared along with their records. So why is it a problem? Well, it distorts mutual funds returns dramatically.
Hey, I got
Officially
a question.
Yes.
Got a quick question in here from Tim, who's joining us from lovely Prescott today. Dave Ramsey is into mutual funds. He likes them very much, and I don't know if you're a Dave fan or not. I have nothing against Dave at all. I know it's easy to give financial advice when you have more money in the bank than you can spend, but that's another story. But he's very personable, and I know he dispenses some good information. I don't listen to him on a regular basis because I'm busy doing other things, and even if I wasn't, I don't know that I would listen. But I like him. What are your thoughts? Why would a guy like him, who I really do believe he has people's best interest at heart, why would a guy like him steer people into mutual funds?
He does. It's strictly ignorance and laziness. Okay. I'm a pastor, and his course, Financial Freedom,
Financial Peace University,
Financial Peace, is taught all over the place, and I agree with almost everything he says. But I've seen him live on TV, I've heard him live on radio. Whenever somebody asks, "What should I invest in?" he just says, "Well, just find a good mutual fund." Okay, but where do I find a good mutual fund? Based on everything you've seen here today, are there any good mutual funds?
Picking a good mutual fund is just an example of getting lucky. It's like getting out at the swing high or swing low of a trade. It only happens by accident.
Yeah.
Because you don't know it's any good, or the swing high or the swing low, till after the fact.
I don't know his background. I don't know if he ever actually worked in financial services or whether he just was a guy. He's real good on budgeting. He's real good on debt elimination.
Yeah, he really knows his stuff.
I like so much of what he says, but buy a good mutual fund is not good investment advice. Okay, so here's just a real quick example of how this bias can really cost you money. Over the last 10 years, tech funds averaged 9.5%. When you include the dead funds, that drops to 7.2%. In some industries, it could drop to as much as half. Okay, but let's just use this one because it's not that big a difference from 7.2 to 9.5. But on a $10,000 investment in dollars, the difference in return is $5,000. Now that does make a difference, right? That's 50% of what you would have made if they were telling the truth and it was really 9.5%. Okay, this is just an example of different funds that have different returns. I want to finish this up. Over that same 10-year period of time, in the worst years, tech funds lost that we should hold their products for at least a decade. If it goes down, they don't want you selling, taking the money, going someplace else. So they tell you, hold them for a decade. Yet there's a shockingly high death rate for an industry that's supposed to be a long-term caretaker of assets.
What happens if you're invested in a fund that does get taken out? Do they just cash you out for whatever you
close it down? They cash you down, they cash you out, and they try to get you to transfer the money to one of the other funds in their family.
Gotcha.
So Money Magazine says, while they preach the virtues of the long term on one hand, these same companies punch the panic button with the other. Shearson's 1990s fund. This is so ironic. It was designed in 1989 to take advantage of the, quote, trends of the 1990s. It only lasted till 1993. Putnam's New Century Fund had an even shorter life. It was born in 2000. It died in 2002. But they're telling us hold for 10 years.
Yeah, right.
So
Right.
vary their mistakes. If you steal a car, you're a felon for life. If you get bad grades, they're always going to be in your transcript. But if you run a terrible mutual fund, you just shut it down and start a new one, especially if you're in a fund family. So please, folks, be careful with fund families. Don't assume because 2 or 3 or 4 or even 10 of their funds are doing well that all of them are going to do well. Now, we're almost out of time, and I'm not going to really go through all these things in detail. But just look up mutual fund scandals. You will see hundreds of them. Okay, the New York Attorney General investigated mutual funds, which resulted in the SEC doing its own investigation. Here's what I was looking for. In 2003, every major U.S. investment bank, including Merrill Lynch, Goldman Sachs, Morgan Stanley, Citigroup, Credit Suisse, First Boston, Lehman Brothers, all of them, every single one was found guilty of criminally aiding and abetting efforts to defraud investors. Now, you can't put a whole Morgan Stanley in jail, so they fine them. And they fine them $1.4 billion collectively. But all that means is those fines came out of our money. They had less profits to pay out because they had to pay all these fines for doing criminal fraud. Here's one that really caught my attention. The SEC disclosed that several brokerage firms actually paid rivals that agreed to publish positive reports on their shares. Okay, they made it appear that a throng of believers were recommending these company shares, which of course was false. From 1999 to 2001, one firm paid $2.7 million to approximately 25 other investment banks, to their competitors, okay, for these so-called research guarantees. I won't go through all of these, but Attorney General of New York, widespread trading schemes. According to the Attorney General, he said what they were doing was like allowing betting on a horse race after the horses finished across the finish line.
Yeah.
Not exactly fair. Goldman Sachs admitted it violated anti-fraud laws, was fined $110 million. I mean, I could go on and on. Here's some other crooks that were indicted, but I highlighted 2 of them because American Express, I mean, everybody trusts American Express, right?
Don't leave home without it.
Yeah. And the NYSE itself and 20 of its specialists were found guilty of financial crimes, and all of these others that you see here. So initially, the primary reason for starting mutual funds, as stated by themselves, was to provide individual investors greater diversification and more professional management than they could get otherwise.
Right.
Okay? Like if you've only got so much money, you can only buy maybe 5 stocks. Well, they can buy 200 stocks. And you're not a professional, so trust me, you know, I stayed at Holiday Inn Express. You know, I'm a professional money manager. Now, that was the initial reason that they give, but if only they'd stuck with that, with their objectives and their promises, I would personally have a much different view of the industry today, but they didn't. It changed in 1976 when beating the market replaced diversification and efficiency as the main objectives. So that was the year when the mutual fund industry turned crooked, as far as I'm concerned.
Right.
Instead of actually trying to beat the market, and they could do that, but they have to take risk. And if you've got a nice cushy job making $500,000 a year managing a fund, do you want to take a risk when you know that you can't make money without taking risks? Or do you want to play it safe and keep your job? As long as you're making at least 2 or 3, 4%, you're not going to get fired.
But you're good with math. Let me ask you a question. If a person had put $500 to work And off of that $500, they were able to generate a $100 profit. What percentage of return would that be?
Well, 20% of the original amount, right? $500 and $100.
So putting $500 to work and generating $100 profit, that's a 20% rate of return?
Gain. That's the gain, yeah.
That's the gain. Because I'm familiar with this opportunity where people can purchase not a mutual fund or an ETF, but they can purchase what's called a Emini Futures contract for the S&P, the Dow, the Russell, the NASDAQ. The S&P I speak of, you put $500 to work there today. If you can take 2 points out of the market today, you will in fact generate a $100 profit. They'll give you your $500 back. Does that mean a person made 20% in one day? They had a 20% rate of return in one day? Is that math possible?
Oh, yeah. I mean, if you annualized it, it would be huge. And when you told me about that earlier today, I was like, or was it yesterday, I guess?
Yeah.
I found that very intriguing. I want to learn more about that.
Well, very good.
You ought to do a whole show on that.
You know, I just might. I might even launch a company and a radio network. Who knows? But I'm going to try to get the word out and let folks know about the incredible Emini opportunity that exists. Come on down. We'll show you how it works. Okay. Are we done?
Well, I have a few more slides.
No, I'm interested. Keep going. Please.
Okay. Well, basically, the problem is that the funds, I failed miserably at attaining this new objective. Okay. Most don't even come close. Right. The actual market action, as opposed to their promises and predictions, has caused a lot of people to re-examine everything they believe was true about investing. And I think that's smart. I think every once in a while, you ought to just re-examine everything just because your granddaddy did it or your father. It maybe is not the best thing. Many of the sacred cows, particularly those that deal with stock diversification and portfolio theory, had proven to be false under close examination by market experts and mathematicians. Well, how can this be? Morningstar, everybody trusts Morningstar. Again, lots and lots of advertising, millions of dollars worth of advertising. But in 2009, the New York Times blew the whistle on them. They said there was only one mutual fund that made a profit in 2008. Yet in January 2009, Morningstar rated many of these abysmal failures as 4- and 5-star funds.
Yeah, and you know, and Morningstar has always been sort of a respectable place you thought you could trust.
Yeah, well, the companies they gave 4- and 5-star funds to in 2009, this is published, this is true, some of them ranked in the So just to wrap it up, the drawbacks of mutual funds, they have inflexible investment objectives. Just because it's in a prospectus doesn't mean that was written 10 years ago, doesn't mean it's good for today. So they need more flexibility. They don't disclose in a timely way their investments, which could result in you having overlaps. You may not know that they bought a certain stock and you buy it yourself. They're tax time bombs. I mentioned I would elaborate on that briefly. Here's how it happens. You're the owners of the open-ended mutual fund. So if the stocks in the fund make a profit, you're sent a report and you have to pay taxes on it.
Right.
But if it was a minimal profit and those hidden and disclosed charges ate up all that profit, and you actually ended up losing money, you still have to pay the tax. So, and then ridiculous and very often hidden transaction charges. No stock ownership. You don't actually own the stocks. You just own a piece of the fund. The investment decisions are done poorly. They're based on the performance of the market rather than the performance of the businesses. Anybody who invests like that, who only looks at how the market's doing and a rising tide lifts all ships and all that, I can show you a million examples of a down market where you could have made millions of dollars buying the right stocks and vice versa. So they should look at the businesses themselves, but they own so many stocks, they can't do true analysis. And diversification, as I call it, instead of diversification, they end up having pets. And so you might have a mutual fund that's supposed to be a diversified fund, and it's got 50% of its money in tech stocks. And then March of 2000 happens, right? So diversification. We'll skip this, but it just shows the differences between individual stock investing. I'm not here trying to talk anybody into investing in stocks. I'm just saying if you want to be in stocks, do it the right way. Buy the stocks. Don't buy the mutual funds. Now, just real quickly, this is Forbes Mutual Fund Tax Guide. 3 of the most interesting points. Funds are pass-throughs, okay? So if they profit from capital gains or whatever, they pass the profits to you. And you pay tax on the distribution whether you do or don't reinvest. So even if you get no money, if you took your profits and reinvested it in more fund shares, you still have to pay taxes. Distribution is a one-way street. Gains and net income are distributed. Losses are not distributed. How is that fair? Okay. In my stock account, if I make money, I pay taxes. If I lose money, I can match that loss off against those profits. You can't do that with your mutual fund. And the distribution can cause pain to innocent victims because you can owe tax on a distribution even if you didn't benefit from it. And again, that's Forbes. I know they got a lot bigger name than I do. So what should I do if I own mutual funds? Should I just go to bed and pull the covers over my head? Change my name? Move to another country? No. Get biblically diversified. I quoted Ecclesiastes 11:2. Have 7 or 8 different investments. Don't put all your eggs in one basket. I love this when the wolf talked to the 3 little pigs. Well, you could put all your money into bricks, but I recommend diversifying to include sticks and straw as a hedge. Well, we know the result of that, right? So if I want to stay in paper, you shouldn't, but if you want to just stay in paper, at least diversify in paper. Don't put all your money in mutual funds. Preferably don't put any. You go into individual stocks or get leaps. Leaps are a great thing to look at. They're like options, not exactly options, but you can buy a leap for up to 3 years on a stock for roughly 20% of the cost of that stock. So that's a great way to invest and leverage. And you got a long term. It's not like an option that expires in 1 to 9 months. And ETFs are another option if you want to stay in paper. But here's my real recommendation. If you want real diversification, you should have precious metals, real precious metals, no paper. Okay. People think if they invest in
GLD or SLV, no, that's not. That's just paper. It has absolutely nothing to do with gold or silver.
Yeah, it's just
it's a front for a criminal cabal.
There you go. That's a very good way to put it. I'll write that one down. But also, people invest in gold stocks. That's foolish. There's a great article. I'll bring it up the next time I'm on. That shows how foolish it is, because the investing in the gold mining stocks or gold stocks in general are not going to bring you anywhere near the returns of investing in the real metal. Land banking, buying raw land. I'm making over 20% a year on land banking right now in my IRA account. Real estate, real estate, not REITs, which is nothing but it's like a mutual fund that only owns real estate. And then there's funds that buy shares of companies that are in real estate, like nursing homes or whatever. That's the best diversification right there, the ones in yellow. But you can also look at a minimal number of stocks, bonds, but be very careful. Don't think that just because it's issued by a municipality, like a state or a county, that it's safe. There have been hundreds of these that have gone bankrupt. Cryptocurrencies, very volatile, but if you're careful, you can make some serious money. Just, I wouldn't bet the bank on it. Leveraged investments, like Forex, commodities, whatever. Also, this may seem off the subject, but just think about investing in yourself. Okay? The Lord may lead you to start a business, which is a little scary, but if you do your homework, you know what you're doing, you're capitalized well, sometimes investing in yourself can be the best investment. Or invest in education that can allow you to get a better job if you're not an entrepreneur, you'd like to work for other people. Get a degree that will help you make more money. So that's what Tom has to say today.
Well, I enjoyed that very much. It was very informative. A lot of things here that I did not know. And we've all heard, we've all gotten the memo, seen the commercial and the infomercial that, good place to put your money is in mutual funds. You're not going to get rich, but it's safe. Well, what price must we pay for safety? And what we just looked at, that doesn't look like safe to me at all.
Yeah. Amen.
Tomas,
look, folks,
the fund families, they're coming for you.
Yes. The main thing, folks, I guess the best advice for investing I could ever give anybody is pray about what you invest in. I mean, if you think about it, it's not your money anyway. It's God's money. He gave it to you. He put it in your hands to shepherd over. And what does the shepherd do? He protects the flock. Okay? So pray about it. If the boss says, yeah, go ahead and invest in this, then invest in it. Because he knows the end from the beginning. Okay?
He wrote the book.
That's right. Well, it's good to be with you. You might want to tell people how they can get in contact with us.
I mentioned it earlier, but I'll tell them again. Go to CFRNgold.com. That's one word, CFRNgold.com. Tell them what they're going to get.
Well, if you go there, you'll get a gold education starter package that has taken years to put together, but has some really good material, reports, videos, and so on. You'll also get invitations to attend our Monday night webinars, and there are
Dr. Tom, the audio dropped out on me again, so in a second it'll come back. I'm on back.
You hearing me?
Yep, now I got you. Okay. Yeah, it just goes in and out. All right.
So if you attend the webinars, great. Live, we have some of the best teachers in the body of Christ, people who are real experts in finance, but they're also Christians and they understand what the Bible says about how we should invest. And we have over 500 hours archived information. So love to have you join us sometime.
Dr. Tom, thank you so much for everything. Thank you very much for what you shared with us today. I hope everyone will take that to heart, and I'll see you tonight.
Okay. God bless everyone.
Bye-bye now. Okay, guys. Give me 1 second. I'm sending a text here. I know. I'm about to do a radio show, and then I'm sitting up here texting. But somebody had asked a question about what I was just talking to Dr. Tom about. about the $500 margin. You put in $500 to work. You trade one S&P 500 E-mini. As an example, that's all. If you take 2 points out of the market, one S&P point pays you $50 per contract traded. 2 points pays you $100 per contract traded. So, if you come to work, whether you're trading one contract, 10 contracts, or 100 contracts, 20% daily return on your money days that you're profitable, right? No guarantees you'll be profitable every day. But when you think about it, you hand your money over to mutual funds, just as an example, because that's what Dr. Tom was talking about. Well, you can see the tragedy there. If you haven't learned how to trade yet, if you're struggling, if you look at a chart and despite your best effort, you just see confusion, give us a call. Send us an email. Go to eminitradingschool.com/apply, and I will teach you as much as you want to learn. I'll teach you everything that I know if you want to learn it. Okay? If you're tired of being at the mercy of funds, an unforgiving market, unscrupulous vendors, if you want some place where you can say, stop the madness, no more gimmicks, no more parlor tricks. I just want to earn a living trading. And in order to do that, some guy on the internet keeps saying, well, you got to learn how to trade. I really just wanted to, click the mouse a few times, point my cursor here and there, and then strut out of the office with, some jingle in my pocket. Yeah, that's a fantasy that really doesn't exist in the real world. But those who have a teacher, those who are willing to exercise self-discipline, those who can wrap their mind around the fact that trading is a business based on probabilities. You'll never be able to run fast enough, jump high enough, or lift enough to beat the market. And why would you want to? Well, the market's done terrible things to me, so I need to beat it. Well, you probably did it to yourself. I did it to myself. The market, it's a force to be reckoned with, but it's a neutral force. It can be used for good or bad. You can use it to create profits, or you can use it as an outlet for all your time and treasure. Gone. And gone is what your money will be if you don't learn how to trade. You don't have to learn how to trade here. But unless you learn how, somebody throws you out in the ocean, you can only keep yourself afloat for so long. Unless somebody teaches you how to walk on water, right? Yeah, well, okay, that's a stretch. Support at CFRN.net, 949-42 E-mini, 949-42 E-mini. Get on the trial, eminitradingschool.com/apply. Okay. Hey, did I show you the gold? I will. We had an alert to be long gold at 1339. It triggered yesterday during this 8:30 to 9 a.m. candle. It went from zone to zone up to the zone. 24.2 points from entry to exit signal. So not here, but here. Look at this, all the way up. Is this an extended move? Absolutely. And you knew that after this candle. So, in an extended move, what do we need to see happen? What constitutes an exit signal? The step line needs to cross over, be on the right side of the blue climbing CFMA1, as it is, all the way up, all the way up, all the way up. The exit signal is when, in a long trade, the first red candle that closes below the step line after it crossed over, that's your exit price. 14.23.20. The swing high is 14.29.40. So will the exit signal get you out of the swing high or swing low? No. No, it can't. No one can, except Lady Luck, because swing highs and swing lows are unknowable until after the fact. We had a change in narrative on gold right here this morning at 7:30 a.m. Eastern. And what has gold done? Zone to zone to the zone. What did it do here? Consolidated. What did it do here? Consolidated. And here, consolidated. What happened here? It was rejected. Price was rejected. Only three things can happen at a weekly trading zone. Consolidation, that's the most popular. Rejection, number 2. And the slice, which is this right here. When price slices through a zone like it's not even there. See this? It slices, then what happens? There's a high probability it will pull back to the zone that it sliced through. Confirm that that zone now, instead of being the resistance it was supposed to be, is going to function as the support you want it to be. And when price there gets rejected like that, get on board. Took us up through this zone where we consolidated this time. Up to this consolidation. Bearish cross. Price goes from being above the BBC to below the BBC. BBC simply means bull-bear cross. As long as price is above the BBC, the green line, we anticipate higher prices. When it's below, we anticipate lower prices. When price hits a zone, we expect it to consolidate. When price falls from above, we expect it to also be good support. On the way up, it's resistance. On the way down, becomes support. Time now for our good word for the day. And then I'll be signing off. Okay, once again, we have a new swing trade underway. Triggered this morning. The channel, let me give you the channel again just real quick. Okay, or I'll ask Valerie too if she's still here. Get a hold of her and she'll give you the channel. Support at CFRN.net. 949 42 Emini. Okay, here we go. Be wise. Stop the comparison. We're always comparing ourselves to others. And sometimes it really disintegrates or denigrates to, well, at least I'm not as bad as he or she or they are. 2 Corinthians 10:12. But they, measuring themselves by themselves and comparing themselves amongst themselves, are not wise. Jesus said, 2 men went up to the temple to pray, one a Pharisee, the other a tax collector. The Pharisee stood and prayed thus with himself, God, I thank you that I am not like other men, extortioners, unjust, adulterers, or even as this tax collector. I fast twice a week. I give tithes of all that I possess. And the tax collector, standing afar off, would not so much as raise his eyes to heaven, but beat his breast, saying, God, be merciful to me, a sinner. I tell you, this man went down to his house justified rather than the other. Luke 18:10. Whereas the Pharisee thought of himself as the best dressed man in town, God saw his garments of self-righteousness as filthy rags and rejected him. See Isaiah 64:6. An unknown poet wrote this: I dreamed death came the other night, and heaven's gates swung wide. With kindly grace, an angel ushered me inside, and there to my astonishment stood folks I'd known on earth. Some I'd judged and labeled as unfit or of little worth. Indignant words rose to my lips, but never were set free. For every face showed stunned surprise because no one expected me. We're all saved by grace, not works. See Titus 3:5. We don't get into heaven based on our performance, but because of Christ's sacrifice on the cross. That being true, don't try to lift yourself up by putting someone else down. Don't assume that you have the right to judge their character, their heart, motives, or even spirituality. When you do that, the Bible says you are not wise. And I know you wise guys. All right, that's our good word for the day. Thank you so much for tuning in. Whoever you are, wherever you are, may God continue to richly bless you with His mercy and with His grace. And I'll see you at the bell.
Remember this, there is no greater return on investment than to see a human life changed and given hope. As always, pray hard and trade safe. Any financial information discussed on this show is simply the opinion of our host, Dwayne Reeves, his co-hosts, and guests. To learn more about trading Emini Futures or to take a 1-week free trial in our live trading room, call 1-866-928-3310. 866-928-3310. Information discussed on this radio program should not be construed as a recommendation to buy or sell any security. Always do your own due diligence and consult with a licensed securities broker or financial planner before making any investment decision.